Good morning, everybody. This is Wall Street Beats. I'm David Maris, and today we have Ben Bry, Charlie Peabody, Berna Barchet, and we're going to talk stocks to look out for and the Santa rally, anything that we're holding on to get the last couple hundred basis points of return, or maybe the first 100 basis points of return for this year, depending on whose picks you've been listening to. So let's kick it off first with Berna Barchet. What do you have for us?
Okay, so I wanted to give an update on Honest Company, which is actually one of the first stocks I ever talked about on this show. And I think I've mentioned it maybe once or twice since then. And it fell into my lottery ticket category, a smaller position with explosive upside, but also a lot of risk. So it was sized appropriately. When I first talked about the stock, it was about $3. This was an IPO in 2021 at $16. This is a natural and sustainable consumer products company, CPG company that has a strong niche in the baby category. So baby diapers, wipes, also does cosmetics and some other household products. The story here was a change of management, a new CEO who came in with having run the Annie's division of General Mills and then later leading North American growth in CPG for Amazon. This is the company that Jessica Alba, the actress, had founded about 14, 15 years ago. Anyway, the stock reported an unbelievable Q3 about a week ago. Stock's up about 50% since reporting. It's up about 120% since first talked about this stock. I'm not selling any. So in terms of the quarter, it was a clean beat and raise. They had the highest revenue they ever had in a quarter in the history of the company, $99 million. A big story here is that gross margins were up 700 basis points. About half of that is from lowering product costs, and half of that is from taking supply chain costs out. So really, this is a classic change of management story. There was always a good brand here and always a good set of products, a lot of customer goodwill, and I think a tailwind. And this is what attracted me to the company in the first place. This is primarily a baby products company. The people having babies right now are millennials and Gen Zs. These customers are much more concerned about the ingredients and the chemicals that are in their products than prior generations were. And this company plays into that. They have a list of about 3,000 products that they will not use, or 3,000 ingredients that they will not use as inputs into their products. They're much more strict than obviously the US regulatory is, and stricter than the EU regulatory is, which is much stricter than the US one. So it's products that people can feel comfortable putting on their little babies and on their own faces and bodies as well. And that is a big tailwind. I think the natural question is, what do you do with the stock that's up so much in a short period? And normally my rule is to take half off the table when a stock goes up 100%. But I treat these lottery tickets a little bit different. When I buy them, these are risky stocks. Usually they're low dollar, small to micro cap that aren't making money. So the risk on them is as much as 100% down. So you wouldn't buy them unless you thought they could not only double, but maybe triple, quadruple, and keep going up. It's interesting. I think that this is a less risky company now at $7 than it was at $3 because before I saw a lot of potential and I saw a management team that finally had the right ingredients and experience to capitalize on the opportunity, but I didn't know if they could do it. I was suspected they could do it. Now I know they can do it and they just need to stay the course. And if they can keep doing what they're doing, the algorithm here is probably like mid-single digit growth or better on the top line combined with continued margin gains, then I see a clear path to 13 and the stock basically doubling again. So I'm actually looking to add to this one opportunistically on down days, which is so not my normal MO, but these lottery stocks are a little different than the average stock.
So,
Anyway, honest company worth checking out, even
so
at
the
these.
symbol is HNST. How much of their business is, because they're everywhere, right? They're in Amazon and Kohl's, and do they have a subscription business, or is it really just no? You're going to go buy it in the store.
I'd have to look at, they do a lot of business online.
Okay.
So on their own website and on Amazon. So I think one of the things that's working for them is their business at Amazon. They grew revenues 15% in the quarter, which was probably a little bit exaggerated versus their normal run rate right now would have been more like 9, 10. But they had the Prime Day build up in there. They had a 10-year anniversary at Target built in there. So there were some events that they shipped to. I wouldn't say it wasn't channel stuffing, but it was just surges in the business. Their business at Amazon, though, was up 19% in the quarter versus 15%. And it's important to also acknowledge that the CPG categories that they operate in were actually negative as an overall group. If you look at the competitive set and the data that's out there from IRI and companies like that, baby products and skincare were net negative across these channels. But so they're taking share. And they're really executing well on Amazon, which I think is probably a testament to the fact that the CEO was in charge of that business before going to Honest, so knows how it works.
What do you think the chance that either an Amazon or a Procter and Gamble or someone, because the P&G's done it with a native brand and how do
100%, 100%. I don't think that they would sell until much higher. When I bought this stock, it was probably around 1 times EV to sales and not making money. Now it's probably closer to 2 times EV to sales and making money on an EBITDA basis and just turning profitable. They made like $100,000 on the EPS line, so just turning profitable. And these kinds of acquisitions generally happen between 3 and 5 times sales. So when I talk about it being worth 13, that's actually using 3 times sales, like the bottom of the range. Could be worth, in an acquisition, it's probably worth a lot more than that. Or obviously, as it keeps on growing, it'll grow its value. But I do think the end game here may be an acquisition because your tradition, whether it's Procter and Gamble, Colgate, Unilever, they're all looking to diversify their portfolios. They call it portfolio management, and they're always dumping things and buying.
is this the kind of customer they want?
Yeah, they definitely want this because this is, first of all, it's a younger customer, which is always good, right? Because you'll have them for longer. And it's in a category that has, that they're generally not in. The big legacy companies use a lot of chemicals. And, you know, I think it's also worth noting, I think that this focus on chemicals is only going to get more pronounced. So you saw a couple of weeks ago, there was something that went very viral about the additives that are in popular breakfast cereals that was all over the internet. And this has been a thing since I was, and the general public became aware of that on social media in the last few weeks. And it's something that RA, who is obviously the nominee for secretary at HHS, is very focused on. So assuming that confirmation goes through, we'll see how much the Make America Healthy Again initiative really goes through. Some parts of it aren't practical, like we can't somehow replace the entire conventional produce supply chain with organic. It's just not realistic. But I do think that there'll be continued talk about ingredients and ingredients that are not good for your body and that are easily replaceable with other items at a small premium. And Honest is really the only public pure play in personal products for that theme.
Mhm. All right, perfect. Make America healthy again, Clay. Not per se, you didn't say that, but it certainly fits that. And
Love him or hate him with the RFK. It doesn't matter if you like him or you don't like him. The fact is, if he gets confirmed, we're going to be hearing a lot more about natural products.
sounds great. Okay, HNST. So Ben, tell us what you have.
If you guys remember, about a month ago, the IPO window started to open up again. And as a guy who loves the IPO window and capital markets, I noticed this company called KinderCare, ticker KLC. And even before it was public, I was getting ready to short it. And so, the price was, and I was ready to go. And they did the deal at 23 or 24. I think it was 23. And it popped post the IPO up to about 28, 29, 30. I got shorted around 29. I talked about it on the show that I was shorting around that level. They announced yesterday. The stock's now at 21. It's getting dropped again today. This is a company that does childcare. This is a company that has 80% ownership by a European PE sponsor. This is a company that's taken hundreds of millions of dollars in EBITDA from the COVID CARES Act and some of the government cheese. This is a company that, not surprisingly, went public before the event that was the election, probably worried that maybe if it didn't go the way of the Democrats, that the Doge might be coming for them. And these guys are now sitting here as an IPO that's underwater. By the way, just so everyone knows, recent IPOs that are under their deal are dead stocks. They're not stocks that people mess with.
So why is that? Tell us, you were on the buy side for a long time. Why is that? Why when things go under deal price, do portfolio managers just say, I'm out?
Because it's not a seasoned security, first of all, right? So the algos aren't going to be involved in this. It's a very low float stock. So if you're a portfolio manager, it's hard to take a position. There's just not a lot of stock. The mentality is, okay, the flippers made money, right? Good flipping stock. First day, first 2 days, then it's stuck. Now everybody who's long this stock from the deal on is underwater. And it's an easy thing to get rid of. And then people just don't really want to be involved in an untested, relying on the government stock. That not everyone's relying on the government, but these guys are. But yeah, you just throw the baby with the bathwater out and you're like, you know what? There's a lot of stocks out there. Why am I messing with this untested brand new stock? Let's see where the real demand, the bid is. And I think that bid's in the mid-teens to low teens, where it's an okay business. Childcare is a necessary thing in society, but these guys have been growing by price, like Pepsi and a lot of the guys who've been taking price and have not much volume. Yesterday, they announced 1% volume growth, 6% price growth. So they did 7% in line with the street. They beat EBITDA a little bit, but a lot of that was a $4 million reserve that will reverse in the Q. Market's not, they know. And so stock's getting dropped. And the reality is it's levered, and the Doge they don't know. But again, this is all speculation, like you were just talking about making America healthy again. But it's an uncomfortable position to be long a stock that's dependent on the government right now when the guys in charge are talking about cutting government costs. And ultimately, I think it's 10 times EBITDA is the max I would pay. And using just this consensus numbers for 25 EBITDA, that's like a $14 stock. And I can make a case why it's less than that. But I'm just saying, like, it's a $21 stock.
Yeah. So if you're playing horseshoes, that's where you say that's your margin of safety.
Yeah. I just think that, like, untested security that only has 15-20% of it stock float. And by the way, one other thing about capital markets is when you have this sponsor overhang, people are aware of that. No one's going to pay up to give those guys in Europe some money. Okay. So you have this negative convexity that sits over these things where anytime there's a rally, you can expect after the close, they're going to be like, well, here's a flyer from Goldman and Morgan that we'll be doing a deal. You know what I mean? And so that's just how it works. So this thing's going to have some wood to chop, in my opinion. And I still think it's the short. It's not as good a short it was at 29. In absence some kind of change from the government that's positive. And by the way, one other thing that I didn't mention in my report or they have long-term. So one of the reasons why the business is okay, they have long-term contracts with employers because you go to work, you got to have your kid taken care of. People lose their job. They lose that. So let's say we're maybe going into a recession, these guys are going to get hit by that because they're not going to have the child from the job. That's like a nice benefit of working at a big company or whatever. So that's another thing that's like just an incremental negative. There's nothing about this that makes me want to be like not short anymore.
Okay. If you didn't own it today, if you weren't short it today, you probably short it now or look for a pop, but even short it now because you're looking for mid-teens and it's still a wage.
I'm staying short. I'm not saying, hey, you got to aggressively short it here on it's gotten drilled. But if there was a pop and it rallied back to 24 or 25 or something like a counter trend rally, I would offer some supply in that. And then one other thing I wanted to talk about was, I don't know, maybe a month ago or 3 weeks ago, I had told people put a collar on the gold because I've been a gold bull for a long time. And it just seemed, hey, we needed a correction in gold. And last week I took that off and I'm back to just full gold bull. Better feeling. I don't like really hedging gold, but yeah, that was a nice, like, healthy correction in gold that we got, and it was needed because it was like it's very uncomfortable owning something that's making new highs every day. I know some people like that, but I personally like to have a little bit more balanced approach to going up. But I guess that if Bitcoin's going 100K on, I don't know, a meme that, gold should continue to perform. But yeah, I took that off and I'm just now fully long gold again.
Ben, on the commitment of traders report, you'll see that speculators did lighten up quite substantially into that correction, but the commercials have been net buying. That's a positive sign.
And I think that there's still demand from gold for central banks around the world. The dollar's really strong and the gold's strong. And so it's really just a terrible time for the rest of the world denominated securities because gold strong, dollar strong. And look, it's a good time to be looking at those things as potential longs, but not necessarily a good time to be holding those things for the last little bit. But yeah, again, like trading gold in the short term, I'm not in any way a master at that. I just think that I could sense that we needed a correction a month ago, and I think we just got a decent one.
All right. And then when you're playing gold, are you GLD or what are you doing for that? So that folks that are interested in looking at gold exposure.
Yeah, I would just recommend GLD. Like I've only lost money trying to trade gold futures in my life. I own a bar of gold that I bought at $39,000 20 years ago.
And keep that in your car, right? Sorry, let's tell back to the make and model and the trunk. All right. So just to jump back on KinderCare, one thing I wanted to mention is that something that I always love to see is when one of the sponsors, one of the banks that cover the company, the first quarter out lowers their price target.
Yes. Morgan Stanley did that today.
Yeah. And when you do that, having that on the sell side, the amount of pressure that there is to like, hey, listen, we just came out with this price target. Do you really, and you're going to lower it by $1? Seriously? Because what you're saying is, the signal I believe that you can take from that is, listen, I'm not a big fan of this.
Yeah. Like I'm not, and you look, because he comes out and they met consensus on the top line. They beat EBITDA, but they beat EBITDA by an accounting mechanism, right? And then you have this overhang of, oh, what's the business going to be going forward? Because we have this huge component that is the government, and we can all speculate, but we don't know. So markets hate uncertainty. Multiple comes down as a result of that, right? And if you had a view on what's going to happen with the government, you could probably take a position one way or the other with more aggression. But I just look at it, it's like, it's an okay business, 10 times EBITDA as much as you want to pay. It's not growing.
By the way, if you really love a stock, and your DCF comes out $1 lower, but you still love it, you're going to find a reason to find, oh, look, the growth rate in 2080 is going to be a little bit higher. Guess what? I'm keeping the price target. To me, that's a signal like, hey, listen, I'm not a fan of this, but let's move on. Hey, Charlie, what do you have for us? Let's wrap up today's call on what do you have?
I have a potpourri of things. Anyway, on Tuesday, I previewed some of the housing sales data that I thought would be coming out over the next 7 days. And this morning we got the existing home sales data for October, and it came in at 3.96 million units, which was a slight beat versus 3.95 expectation. Listen, anything below 4 million units is weak. It's a weak housing market. There's no way around it. But if you're a bull, what you're going to point to is that this is the first year-over-year increase in, I think, something like 18 months. Now, I want to caution about getting too optimistic about that increase for a couple reasons. The October existing home sales data really reflects the contracts that were signed back in August and September when we had a mortgage rate closer to 6% rather than today's mortgage rate, which is closer to 7%. And this increase was foreshadowed by the pending home sales index, which last month rose 7.5. And that is usually tells you what's going to happen 1 to 2 months out. I think this was known that we would have an increase and the bulls may run with it, but I think anything under 4 million is still suggesting a very weak housing market. I'm still a seller of the home builders on any sort of rally here. D.R. Horton, Lennar have been the names I've used just because they're the biggest and they have the biggest expense structure that still needs to be fed, and they're going to continue to experience what I would call gross margin pressure as they have to use incentives to get homes sold because the affordability problem. So that's point number one. Number two is the day after the election, I came out with a framework of how you could value banks going forward under the new Trump administration. And I cited 5 things and suggested those 5 things could generate another 20 to 25% upside in bank stocks from the pre-election prices. And the 2 biggest things that would improve earnings, one was the tax cut. If we get a tax cut from 21% down to 15%, that could add 6 to 8% to the bank's earnings because they pay a full tax rate. Unfortunately, we're not going to get a sense of how that's going to play out until probably into the second quarter of next year. So that's more on the come. The other big thing was the banks could get re-rated higher because of a lighter regulatory touch, and you wouldn't have that headline risk or that expense in your operating leverage going forward. And I suggested that could add about 9% to their rally as they get re-rated from 55% of the market multiple up to 60% of the market multiple. Today, the bank stocks are trading at 59% of the market multiple. So tactically, I would say the things that are going to happen near term, like improved capital markets and a re-rating, have occurred. The things that, could cause further upside are going to be delayed in their recognition. So tactically, I want to take some money off the table as a short-term trader on these bank stocks. And I think names like JP Morgan and PNC, these are 2 excellent franchises, are a little ahead of themselves. So I'm a profit taker as a trader here. The one name that I would like to continue to buy is Citigroup. And I had suggested earlier this year when I recommended Citigroup as my primary long, that fair value by the end of this year was in the mid to high 60s. We're there today. But I think the fair value moves into the mid to high 70s next year. And the real payback will be in 2026, where I think it can be a $100 stock as they improve their ROE towards low.
So would you do a pair trade of 2 individual stocks, or would you pair Citi with a few of the other major banks just as kind of a basket?
If I were to pair Citi, and believe it or not, it would be against Wells Fargo, which I think Wells Fargo is fully valued on the expectation their asset cap's going to be removed. So at 73, 74, wherever the stock is this morning, I think there's very limited upside in the short run. And I think that stock could pull back. And whereas Citi, I don't think has as much downside risk. Wells Fargo trades at 1.5 times book. Citi trades at 70% of book. There's the same story in the sense that Citi is 3 months, is the same Wells Fargo story, but 3 years ago. So they have this ability to bring down their expense structure from $54 billion down to $51 billion as they work through the simplification and reorg. And so there's potential significant positive operating leverage, and their capital is about to improve as they, spin off Banamex in Mexico. So I like that pair trade. Sure.
You said potpourri. Is there anything else left in this cornucopia of stocks that you have?
I just mentioned because retail sales, our retail earnings are coming out right now. And I'll leave the characterization of those retail earnings to Berna, but I just want to point out that the credit card securitization trust data is showing higher delinquencies. And I think we're going to be at new highs for this cycle by November, December. So we get the November data and December data in January. And we're already seeing new highs in credit card delinquencies at some banks like Citigroup and Bank of America. Now, I want to be quick to point out these delinquency numbers are not alarming, but they're moving in the wrong direction. So if there's anything that disrupts the economy next year, we're not going to see the improvement in delinquencies and charge-offs from the credit card side that most people are anticipating. Credit card stocks have been phenomenal this year on the belief that credit quality is going to get better. But the recent data is showing the opposite.
So here's a question for you. Amex. Everyone says, and for the longest, since I can remember, they're insulated. But the stock's gone from like 150 to 300 or 290 in a year and a little bit. At some point, does this increase in delinquencies have an asymmetric effect on the companies that are supposedly insulated, but have actually just the stock prices has zipped up a little bit too high? Or is that just, no, that's trying too hard? It's still insulated and it's still not that expensive.
Yeah. I think there are 2 things to point out, David, on your question. First of all, a lot of the run that the credit card stocks have been on the basis that the CFPB is going to be eviscerated under the Trump administration. And so all of the caps and rollbacks that the CFPB has proposed for the credit card industry won't go through. And so the revenue upside is that much greater. And then the second thing is we do have a K economy. And here I'll defer to Berna as to whether she believes in that or not. But the upper end still is spending and still looks healthy, and American Express caters to the upper end. The one area that I think people need to watch carefully now is the small business area, because I'm hearing from my banks that they are starting to put a lot of small businesses on their watch list for deterioration, margin deterioration related to higher labor costs, higher healthcare costs, higher product costs. So I'm seeing some deterioration in small business, which could affect American Express at some point.
Right, we're going to wrap it up there, but I do want to give you one thing to do, Charlie. Several of the banks in my area are now closed on Saturday. I don't know if they're trying to save money or what, but you have to get on that case because
David, there's something called digital banking. Have you heard?
that's
Or crypto. You don't know if you heard, there's a thing called Bitcoin. You can instantly transfer it. Works a little gummed up. Might take a couple hours, but
2024 was the year that I learned to easily pay with my phone. So I'm aware of that. I might be a couple years behind, but I'm going to stop while I'm behind. And this is Wall Street Beats. I appreciate everybody listening in, and we'll see you next time. Thanks.
There's always the night depository slots if you need to.
The little box.